All right, hey guys, it's Kevin, and this is video lesson number 9 in your calendar course that you are progressing through. So let's just take a moment to kind of recap where we've been and where we're going. Last video lesson, I spent a great deal of time talking about earnings, plays, and news announcements, and several examples on various different equities that we have listed right here. Just how you can take what you're learning about options, calendars specifically, and how sensitive these options are to changes in volatility, specifically how sensitive they are to changes in different expiration cycles. So if we are looking at options that expire in 4 days versus 32 days versus 60 days versus 158 days, they are all going to react a little bit differently to those changes in volatility. That is probably the crux of everything that I'm wanting to teach you guys and share with you guys going through all of these lessons. In calendars specifically, you have to be aware of that volatility in the different expiration cycles. So we went through a lot of different examples in low price stocks, in high price stocks, in stocks that moved a lot after earnings, some that didn't move so much after earnings, just to give you a good idea, a good representation of what you can expect with some of these different underlying assets. Now, what I want to do in this video lesson is kind of follow the similar format, walk through a bunch of different examples, different market conditions. We'll maybe go back and look at 2008 for an example or two, 2011. We'll look at 2014, just to show you different time periods when we have low volatility transitioning into high volatility. When we are trading in a high volatility environment, we transition back into low volatility. Just the different ways that these calendars are going to function in different environments. And then lastly, we'll just talk about my thoughts on using the big major indices in the US and their accompanying ETFs. Remember, calendars can be traded on anything that has options. If you look at any option chain, if there are options tradable on an underlying asset, then you can trade a calendar on them. And the strategy or the method or the management really shouldn't change too much from equity to ETF to index to, you can even trade calendars on options on the futures if you desired. But each different approach is going to have its own little personality. So that's up to you to just test and get exposed to all the different ways you can trade a calendar. So what I want to spend 30 or 40 minutes here in this lesson is walking through just some of these different cycles on these 4 major indices, these 4 ETFs that follow the indices, and just share with you my thoughts about trading calendars. Okay, so let's go ahead and just get started. The SPX and the accompanying SPY are probably the first point that you can go to if you wanted to start trading calendars with very little risk. All right, not the SPX, I'm talking about the SPY right now, but the SPY follows the SPX. The SPX is probably one of the most heavily traded vehicles out there. The SPY has the most volume and the most open interest. So, and let me just show you, if I bring over this, these are active option chains right now, and if we come, we'll just say 30 days to expiration in SPY, And if we look right at the money, we've got calls on the left, we've got puts on the right. The market's only been open a little over an hour, coming up on 90 minutes this morning. There are 26,000 contracts of open interest at this strike, 206 calls. 3,124 of them have already traded this morning. On the put side, at the 205 strike price, you've got 120,000 contracts of open interest, and 3,048 of them have already traded this morning. All right, and you can see those numbers change. This is real-time data that's coming in. So for our conversation's sake, let's just talk real quickly about why this is so important to be aware of. Open interest and volume are the two biggest things we have to be paying attention to. If there is no open interest, there is no market. And we could find that in any underlying asset. Boy, you know, I'd have to... let me pause the video and I'll go find one that has very little open interest. Okay, so this is a stock. It's company SP Plus Corporation. Have no idea what they even do, what they're all about. But they do trade options. It's $22 stock, and you'll see there's no open interest. There's no volume. You've got 31 days to expiration. You've got 3 days to expiration. You've got 59 days to expiration. There's a little bit of open interest here. You've got 18 contracts open interest here. So if I were to go into the market right now and say there are 10 contracts of open interest at the 20 strike price for October of this year, 157 days to expiration. The bid and the ask spread is super wide. Now, there are no contracts open at this point in time. If I wanted to buy a put option on this company right here, and I executed a trade or I transmitted an order, as soon as somebody filled that order, then there would be one contract of open interest. That is a legal binding contract between me and another party, so there would be one contract of open interest. If I buy that contract or I buy that option, I have it for 2 weeks, and then I turn around and I sell that, and in essence that closes that contract, meaning right now I would buy to open, and a week from now I sell to close. Once that contract is closed, open interest would return to zero, meaning if nobody else traded over the next week this strike price at this expiration time, the open interest would go from 1 back to 0. So open interest is very relevant and very important to stay in tune with, so that you can see when you are looking at the most liquid underlying asset here, the SPY, 31 days to expiration. This open interest number is always going to be changing, and that number changes based upon the quantity of contracts that are transacted throughout the day. So if we take a snapshot at the end of the day and we can see how many contracts are traded volume wise. Okay, so sorry, I had to pause that for just a second, take a rather urgent phone call. Anyway, so open interest, contracts, volume trade. If you take a snapshot at the end of the day and you could say, all right, let's look at this strike right here. If there is 150,000 contracts of open interest, 1,000 traded a day, what you have to recognize is that of these 1,009 contracts of volume, some of them are going to be opening new positions, some are closing existing positions. There's really no way to know if somebody is buying or selling other than monitoring how this open interest changes throughout the course of the day and going into the future. But you have to understand that if there is no open interest, none, zip, nada, period, absolutely no open interest at a strike, that doesn't mean that you can't trade this. That just means that if I wanted to go in here, if I wanted to buy this contract right now, I am the only market and I am going to pay through the nose for it. I'm going to pay up in the spread, and then if I've created a calendar trade, for example, and say I am selling one and buying another, and I need to get out of it, and I am the only market and I am the only open interest, well, it's going to be virtually impossible for me to get out at any kind of a reasonable amount. So when trading these types of strategies, especially calendars, you have to be aware of that and respect that, so that when we're starting out in the SPY and we're learning, that has the most open interest and the most volume across a wide spectrum of strikes. All right, so it's a good way to get into the options world, if you will, for very little risk. You're able to see how these options react. You're able to learn how volatility changes influence a position, and then as you begin to gain that confidence and build that skill set, you can branch out into many other vehicles and many other areas. So let's go in now to SPY, and we'll just, this is May 17th, 2016 as the date that I'm recording this, and this is the current market snapshot over the last going back here to early 2015. So we'll just say if I wanted to come in at this point right here, let's say a year ago, I want to come in and I want to initiate some calendar type trades. Well, if I go into the SPY and I go back in time to, we'll just say 5/13/2015, and I want to monitor and show you how some of these calendar trades perform, well, right off the bat, you should understand the negative skew you have here. The front month is less than the back month. All right, that's the first thing you have to be aware of when you're trading calendars, is implied volatility. If I'm coming at the money and I say, well, I want to, if I have to pick between a call side and a put side, well, this is 12.2, this is 13.0, this is 12.3, this is 12.9. This has a smaller negative skew, so if I did this, the trade cost me $124. If I did this, trade cost me $98. So this trade is less expensive. This is a cheaper net margin, but you're also having less implied volatility, that you're receiving less of a credit for this one that you sold. And while yes, you are paying less for the protective hedge, your implied volatility has already widened out and you are starting out a little bit behind the eight ball. So that skew is one of the first things you have to be aware of. So you can say, all right, I've got a $124 trade. I've got 38 days until these options expire. This is what my risk profile graph looks like. I'm fairly flat on my T+0 line. I've got a defined window of, between 205 and 214 in which I need to pretty much stay. So it pretty well encompasses, this right here, 205 to 214, and you are a lot less susceptible to gap risks. You have no exposure to earnings announcements. I mean, this is a basket of stocks in the S&P 500, and you have ETF trading on that. So you saw thousands of contracts trading, very liquid, penny white spreads, no slippage really essentially will be incurred, and you can begin learning for as little as $124 or less how these calendars operate. So, we could step through a couple days in time and say, now let me watch how this changes and this decays. And while I'm not going to be making money to break the bank with, at least I am gaining the confidence and learning how a calendar operates, and say, all right, well, I don't really need to do anything until we get up to this expiration break-even point, or just a little bit inside of it. And if that's my mindset and approach at the beginning, then I have to make sure that I am following that plan all the way through the life of the trade. And it's much easier, so much easier to do that when there's little skin in the game, compared to you decide to throw on a $25,000 trade and it starts going against you and you don't know what to do. So again, the whole point of learning on this underlying is not to try and make a ridiculous amount of money. You're not. You have commission load, you're very small amounts of margin to trade these, but at least it gets you exposed to how these calendars are going to operate, while still giving you an opportunity to make profits along the way. All right, and you'll see, we really have had to do nothing, and the front month options are just continuing to get closer and closer to expiration. So that's one viewpoint that I want you to consider when you're first starting out. Staying in the SPY, you're not trying to, $14 is $14 on $124 is obviously 10% return on capital. But by the time you calculate commissions, and you're never going to consistently and long term be able to find an edge trading a calendar trade in SPY. But you will gain confidence and you will be able to monitor and watch how implied volatility changes, and why when this skew gets out of line on the front month and the back month, how profits can be gained or lost very rapidly, so that when you graduate or you move up to SPX or NDX or Apple or Priceline or whatever the vehicle becomes, you're able to know what is expected or be prepared for what may or may not happen. So I hope that makes sense, all right? Because SPY is certainly where you should be beginning when you're first starting these out. But if we went back here and we said, all right, what was the date? 5/13, and we went on this date and we said, well, instead of doing an SPY, let's do it in SPX, because this was a relatively sideways market, right? There was nothing really going on. We already looked at what the price chart was doing. Okay, just took it a minute to update there. So you saw the price chart was doing the same thing, going sideways here in the SPX, but now instead of in the SPY, well, now let's go into the SPX, and you'll notice 11.3, 11.9. So if I wanted to trade one calendar here, it's an $1,100 trade. All right, I'm selling less than I'm buying on the back side. And compare that to the put side, it's a $1,300 trade. All right, you're selling more, but you're paying more for the upside. This skew right here is less, it's narrower in the call side than it is on the put side, but it is 0.1 difference, so it's essentially a non-issue. But you get the same kind of profile, you get the same kind of risk graph, you get the same type of management style. I don't do anything from 2065 to 2150, and you just walk through and you can see, all right, this is one contract, it's a $1,300 trade. if I go through a couple of weeks to where I did on the SPY only make you $14, but yet the SPX is going to make you, 140 or even more, just depending on what this volatility is doing. So you'll notice right here we're still hanging right on the edge. I think it was maybe the 30th. And we never reached that point where we started getting out of the tent, the expiration break-even graph. You never get outside of that point to where you have to do something, and so you just let your options continue to decay, and this that you sold for 35 you buy back at cheaper. This you paid at 49 for, you have to sell it for cheaper, but the direct relationship between the SPY and the SPX, they work and they function exactly the same way. All right, so the only difference then being, of course, bigger underlying, much more premium in this type of vehicle, SPX. All right, so let's get rid of that, and let's just walk through a couple of trades back in time. We'll use SPY. We'll make sure that we get rid of that. And we say we go back to 2008. Why don't we do that? Let's go 7/5/2008. And you'll notice that okay, so sometimes you need to just go in and do little things like this. So this is the selected asset. We are going to update the price chart file, selected file, SPY, okay, and then we're gonna go back to, we'll just do 1/1/2002. And then it should bring in all that data going back in time. So this is the market we were looking at. 2008 had already begun selling off pretty harshly. And you can see now that the volatility is elevating, so that in this one, we've got the front month that is higher than the back month. And you can come in a very simple calendar trade and say, I want to put on a $150 trade that has a pretty flat T+0 line, because I know that when this falls back in line, meaning equal or less than, in the bigger basket of stocks, meaning SPY has a larger basket because it tracks the S&P 500, it's not going to be trading like an individual stock that has earnings, that has gap risk, that has news events. It's still going to be sensitive to world events, but you'll notice that it's a lot more calm and it reacts a lot more controlled. So we could convert that and we could say, well, let's just go through a week at a time and watch how those options decay. Again, it's a $150 trade. You have a predefined area between 117 and 131 in which you can stay profitable. Pretty wide area, and yet you're just coming off of a big downward slide. So would there be any concern about putting this kind of a trade on while you're learning? It still has a potential to give you a decent return on margin, but your commissions are going to take the majority of those profits away, okay, while you're learning. But while you're learning, what you are gaining is just, again, that confidence that is so important. So what do you do on this one? You'd say, well, all right, I've got a $150 trade. I may be a dollar commission-wise in and out on each contract. So I've got, what, $2 in commissions at this point. So I've got an $18 profit on $150 minus $2 on the way out. So I've got a $16 profit on $150. That's still 10%, right? So you can still make the returns, but the percentage, the ratio of commission to profit on these smaller ones is a lot more devastating than if I was in SPX or even NDX. We'll look at NDX next. So you can say, well, I don't want to do anything till here or here. I let the market tell me where it's going to take me. And I'm in no danger until I get way out to this point. And that's the whole premise of a calendar trade, you guys. I mean, I feel like by at this point, if you've already been listening to all of prior videos, you've probably got a pretty good handle on it. But I think it's so important to continue to drive the point home. It's all about volatility. It is all about volatility. If all of a sudden, for whatever reason, I had a massive spike up in volatility, 23 days to expiration on this one, 58 days to expiration on this one, and this is my current trade. This is where I'm sitting at. I'm sitting very pretty. I'm very happy. I'm up $35 on a $120, $150 trade. I'm super content. And all of a sudden, for whatever reason, I get a massive explosion in volatility. Now, I can simulate that by saying, what if all of a sudden this option became worth $4.50? You can see that you change the price, it changes what the anticipated implied volatility would be. So if the implied volatility cranked up on this to 37%, but this only cranked up to, I don't know, we'll say 25%. So there was an obvious discrepancy, right? Well, bye-bye profits. All of a sudden you went from being up 35 to being down 75, and and it didn't go anywhere. The market didn't move anywhere, right? And you lost all of those profits because of the change in volatility in 1 month, not matching the same ratio or the same percentage change in the back month. So what's really so mandatory and so important, you have to process when volatility changes in 1 month, if it's different significantly between the back month, that's why you will make or lose profits and money on calendar trading. All right, so that's the SPY. So we want to say we'll close this one out, and we kept our $35. We were in no worry about it, but we just wanted to get out of it. Now that's from 7.7 to 7.24. Let's do the same thing in NDX and just see what that ended up doing. Again, 2008 financial crisis is hitting pretty heavy, and we want to see if we would still be considering trading in that environment. And we'll go here, we'll change that. So I've got 1825. If I came right at the money, I sold one, I bought one. Now, I want you to notice, look at how expensive and look at how much premium is in the NDX. One contract gives you a very similar profile, right? I mean, you have defined risk, you have defined profits, but the scalability to these it's very profound. If you get skilled and you get confident and you get able to trade these in one vehicle, and you slowly and incrementally build up to another vehicle, say as this, and this is a percentage of your account that doesn't bother you, these perform the exact same way. And we went from 7.7 to 724, so we go to 724, and then obviously you're going to notice that the change in profit is, you know, all of a sudden the commission load becomes it becomes a moot point, because if you're making $488 on $2,300 worth of margin, $4 of commission is really, it's insignificant. It doesn't matter. And you're in a trade that has still the potential to continue building. So if that were, oh, I don't know, let's say instead of 1, you were trading 10, you were fine with it, and that's acceptable to your risk parameters. Oh, that was the wrong one. I changed the SPY. Let's change the NDX. And that's acceptable within your, account size and your risk tolerance, and you can handle that. All right, well, now you've got decent profits built into this trade. You're not ready to close it up yet. You still have time left. Well, all right, then you can begin maneuvering out of it, closing portions of it as you go, while still keeping the overall structure intact. All right, so the takeaway point to all of this, for the majority and for the most part, is the implied volatility is what you have to be aware of. And it doesn't matter if it's SPY, if it's NDX, if it's SP, it doesn't matter what the vehicle is. You have to monitor the open interest and the volume traded. If I looked at NDX right now and I said, all right, well, if I were considering doing something like that right now, all right, I do have some open interest, but look, there's been very little volume traded thus far today. You've got pretty decent bid-ask spread, but you have a lot of juice, a ton of premium. If I'm selling an option that's $7,500 worth of premium, and I am going out in time and buying the protective hedge, and I'm having to pay, obviously a lot more to protect that, but the functionality of how this operates is no different, zero difference than an SPY or IWM or the Qs or Apple. The approach is still the same. All right. So I will probably consider closing up on that. Let me just go back. Let's do this. Let's go back in time to. We'll do one more little case study, one more little example on the SPX. So if I go back in time here and I say, all right, I don't want to go back to the August drop here. Let's go back to, does this only just take us back to there? So update price chart file, update SPX. All right, so that takes us back a little bit farther. So, we can go all the way back as far as we want, but if, let's say I'm coming back into this point in time here, 2002, July 5th, and let's just compare one period of time to another. Maybe it's not populating for some reason. Maybe it's only, let's see, Well, let's update the selected asset. Okay, well, I updated all the price charts and still not coming through, so why don't we just go to a different period of time, and we'll say, all right, I'm trying to find a period to say, all right, well, this looks pretty good right in here. So we'll say the end of 2005. So we'll say 10/27/2005. And what we will notice is that we're still low volatility environment at that point. This is our price chart. We have at that point in time, however, implied volatility. If you look at this from a 1 year rearward looking perspective, it's coming up on the highest edge of where it had been trading in the prior year from a implied volatility only perspective. You don't even know what the price chart is doing. You're just looking at implied volatility, and it is at this point you've got an IV of 14.6, and at one point probably in the lowest valley here it was 9.2. Okay, ridiculously low. Option premiums are all but non-existent at that point, and you're coming out of that area. So when you look at a price chart, all right, well, price is dropping. So if I came in and wanted to put on a calendar, do Dece March, or we'll just do this here, 14.2 is much higher than 13.7. It still gives me the same approach. Nothing changes. Fairly flat T plus 0 line. I have defined window of where I want the market to stay in before I have to make a decision on adjusting. So I know these zones at the beginning, and I can say, all right, no different back 2005 to 2008 to 2016. The functionality is exactly the same, and we'll see that what ended up happening is we get up to that point and we have to decide how we're going to manage it. The implied volatility changes exactly the same whether it's 2005 or 2016. So that becomes a moot point when traders say, yeah, but it doesn't react the same way today as it did back then. Well, the market condition might be different, but the way the options decay has not changed one bit. You're down money because you let it get way far outside of your tent here. So I think I'll kind of seal it up on that one because I don't want to just keep belaboring the same point. I hope that you guys get what I'm trying to emphasize here, that it doesn't matter what the vehicle is. The calendar approach functions the exact same way. And what you really need to be paying attention to is that implied volatility between the different months. So starting out, if you jumped right in on Apple and you traded Apple for 6 months and you got very in tune and in sync with Apple's personality, and then you jumped over to Facebook or First Solar and you got in tune with that personality, all right, the mechanical side of how calendars operate is not going to change. The individual underlying will. And they're all going to have a unique flavor and a unique flair, and that's why until you get to that point where you can recognize that and understand how calendars operate, please just stay in the SPY. Please stay in the IWM or the Qs, wherever you feel comfortable and confident taking the risk, well, just stay there while you're learning and while you're building. And if it takes you 6 months of only trading SPY and SPX or IWM and Russell so you can get familiar with those without exposing yourself to gap risks or earning announcements, and then you're able to more easily transition over into some of these other equities. All right, so start there, and please don't take it lightly. It's super relevant and super important. All right. Next video lesson number 10, we're kind of starting to wind this down and get this dialed in so that hopefully you are understanding the calendars a lot better at the end than you were at the beginning. But next video lesson, I just want to kind of segue and piggyback the same way I'm talking about right now. Just an overall global recap of calendars. A checkpoint to be looking for volume, looking for open interest, watching for the volatility skews, looking for earnings announcements, watching what the price is doing. Paying attention to what industry it is that you're trading in. If you're trading in tech, or if you're trading in big pharma, or utility stocks, understanding that, and just kind of give a good review and a recap of how I think new traders should be approaching calendars, how I think intermediate traders should be approaching calendars, and then lastly, how the advanced traders should be approaching calendars. Calendars 100% hold a place in options trading. It might not be your core trade, but it might be something that you want to add in at different points in time, either to offset an adjustment with an advanced hybrid type trade. Case in point is you may have a butterfly that's got an embedded condor that needs a little bit of Vega twist, and you need to add something in a short period of time, and you recognize a little skew difference, so you're able to correct delta, boost theta, and offset Vega with a simple calendar, and that is the optimum adjustment at that point in time. And if you don't understand how the calendar will work, then you're really kind of playing with fire a little bit. So calendars do hold a place in options trading. Some traders trade them exclusively, some only use them as adjustment vehicles, some don't trade them at all. All right, but my hope is that by recapping and just kind of reviewing my thoughts about them in the next video lesson, you'll be able to add that to all the prior videos and take that knowledge and be able to apply it. Okay, so guys, thanks much for listening, and we will have just a couple more videos coming up, and then we will certainly move on to the next course. All right, thanks guys, bye.